This video is only for education purpose. Imagine waking up one morning and realizing that everything people believed about wealth, stability, and the future suddenly collapsed. Imagine banks shutting their doors, millions losing their jobs, entire companies disappearing overnight, and the world entering a financial darkness that would last for years. What if I told you that all of this chaos started with a single event, the stock market crash of 1929? In today's video, we're going to break down exactly what led to the Great Depression. What really happened inside the market during that crash, how ordinary people were impacted, and the powerful lessons modern investors can learn from it. Even though this event happened nearly a century ago, the mistakes made back then still happen today. People still chase quick profits, still fall for market hype, and still believe that stocks only go up. The secrets hidden inside the 1929 crash explain why market bubbles form, why they burst, and why disciplined long-term investing is the strongest shield anyone can have. By the end of this video, you'll understand why the Great Depression wasn't just a crash, but a series of decisions, emotions, and economic pressures that built up over time. And more importantly, you'll see how modern markets, from the S&P 500 to big companies like Apple, Amazon, and Tesla, still operate on the same psychological patterns today. So stay with me as we decode one of the most important financial events in history. Welcome to Crypto Brainpower. This channel is all about helping beginners understand the stock market, the lessons hidden in history, how markets evolve over time, and how long-term wealth is built through simple, practical knowledge. If you're looking to learn in a clean and easy way without hype or confusion, you're in the right place. Let's begin by understanding what the Great Depression actually was. The Great Depression wasn't just a market crash. It was a long period of economic collapse that lasted for about a decade, starting in the United States and spreading across the world. The spark that ignited this disaster was the stock market crash of October 1929, often called Black Tuesday. But the real story began years before that moment. In the 1920s, the U.S. economy was booming. People felt unstoppable. New inventions like automobiles, radios, and home appliances created excitement. Companies looked strong, and the stock market kept rising. More and more people wanted to get rich quickly. This is where one of the biggest mistakes happened. A huge number of people started buying stocks using borrowed money. This is known as buying on margin. Imagine using $10 of your own money and borrowing $90 to buy a $100 stock. If the stock price goes up, you make money fast. But if it drops, you can lose everything even faster. It was a risky strategy, and millions of Americans used it without understanding the danger. By 1929, stock prices were no longer connected to the real value of companies. They were inflated. People were buying stocks just because prices were rising, not because those companies were truly growing. This created a giant bubble. Eventually, fear entered the market. Small drops in price triggered panic. Investors who borrowed money rushed to sell. This selling triggered even more selling. On October 29, 1929, the panic turned into a full collapse. The market fell so fast that brokers couldn't keep up. Billions of dollars vanished in a single day. People who believed they were becoming rich suddenly lost everything. But the crash was only the beginning. Banks had also taken huge risks. Many banks had used customer money to invest in the stock market. When the market crashed, these banks failed. Millions of families lost their savings because there was no insurance system like the FDIC back then. People lined up outside banks, begging for their money, but the doors stayed locked. Businesses shut down because they couldn't get loans. Farmers couldn't sell their crops. Factories closed. The unemployment rate rose to nearly 25%. It was a complete financial freeze. One important lesson that came from this event is the power of diversification and long-term planning. Many investors had put all their money into just a few companies. When those companies collapsed, their entire life savings disappeared. Compare that to a modern diversified index fund like the S&P 500. Today, investors use platforms like Fidelity, Robinhood, or Charles Schwab to spread their money across hundreds of companies, reducing risk. Back then, people didn't have this kind of protection. Another lesson is emotional control. In 1929, fear spread faster than facts. People sold out of panic, not logic. This still happens today. Even during modern events like the 2008 financial crisis or the 2020 pandemic crash, fear created massive volatility. Smart investors know that emotions are the biggest threat to long-term success. Let's look at a simple example. If someone invested $1,000 in a strong company like Apple and held it through ups and downs for many years, they would have eventually seen growth, even after market crashes. But if they panicked and sold during a downturn, they might have locked in losses. The 1929 crash teaches that markets recover over time, but only for those who stay disciplined. Another important point is understanding economic signals. Events like the Federal Reserve interest rate decisions, inflation data such as CPI and the U.S. jobs report can influence market behavior. In 1929, many of these tools were not used effectively. The government and the Federal Reserve reacted slowly, which made the economic situation much worse. Today, markets still react strongly to these signals, but at least the systems are more advanced and transparent. For beginners, one of the biggest takeaways from the Great Depression is avoiding the temptation of quick profits. Most people who lost everything in 1929 were not long-term investors. They were chasing fast money. When the bubble burst, their dreams burst with it. Long-term, steady investing has always been safer than short-term speculation. So what can you learn from the Great Depression? Understand the value of patience. Focus on real company strength, not hype. Avoid borrowing money just to invest. Diversify your investments. And never let emotions make your decisions. Even though today's markets are far more advanced, the basic principles of human behavior remain the same. Fear and greed drive markets up and down. The investors who survive and grow are the ones who stay calm, stay educated, and think for the long run. Thank you for watching. If you found this video helpful, subscribe for more educational videos that make the stock market simple for everyone.